Well, hello and welcome to our up close and personal look at a fund called WCMQ. We're going to find out why this fund has done so well to answer a few questions you might have on WCMQ and the manager, WCM Investment Management, which is a US based company. Before I welcome my guest, this webinar is for educational purposes and is of a general nature only. It does not constitute personal advice and it must not be acted on or relied upon. The presentation is not an offer, recommendation, or solicitation. Be clear on this. If you'd like to ask questions, please submit them via the interactive chat box. And we're joined by Paul Black, who's the co-CEO of WC Investment Management, who comes to us from sunny Laguna Beach, California. Good to speak with you, Paul.
Thank you, Peter. It's great to see you again.
Yeah, same here, mate. For people who don't know about the history of WCM, can you just give a background of who you are personally? What is this business? And, why is it your style of investing quite unique?
I'd be happy to do that, and I'll start by telling you a little bit about WCM. We are a $115 billion asset management, money management firm, and we're known around the world for running global equities. We've got a very enviable track record over 15, 20 years. We've been doing it a long time. And, you mentioned how do we do things, and we'll talk about that. But what we do is very unique from every other money manager. And I know a lot of managers say that, but in our case, it's actually true. We're going to talk about things that most money managers don't talk about. And all of those new insights that we have on investing have come through a lot of kind of pain and anguish and mistake making. I always often refer to WCM as that family portrait over the fireplace. Everyone has one. And when you think about it, everybody looks wonderful. You're on the beach, you got the ocean behind you, everyone's dressed perfectly, the kids are behaving, even the dog looks good. Everything is beautiful. And that's what WCM looks like today. $115 billion of assets under management, best track records in the world across the board. We have 97 people in the company, 67 of whom are owners. So they own shares in the organization. What's not to love about that? Well,
Mm.
like those family photos, there's a lot more behind the story. And we've had a 25-year journey of a lot of ups and downs. Again, people will look at us and say, wow, aren't you great? Well, we haven't always been great. And I would argue that it's during those periods of very difficult periods of time where we've underperformed and made mistakes that we have turned those into great strengths, and we've used them to become much better at our craft than anyone else. Look, everybody in our business is incredibly smart. Everyone in our business works really hard. But what people don't do as well as we do is they don't tend to be learning machines. And I always think of our firm as a bunch of people who are complete learning machines, always trying to iterate and get better at our craft. And that's proven to really be the case, especially in the last few years when the markets have been very, very difficult. So
Yeah.
real quickly, I started in the banking industry about 40 years ago and joined this firm. We actually bought this firm in 1998 from the original founder when it had only $200 million under management. A lot of what we talk about, and we'll talk about it, I know, Peter, is around people and culture and how important that is to anyone's success organizationally. And that's the gift the founder gave us because he was a completely toxic person with a very toxic culture that crushed the hearts and soul of the people there. And we actually learned from him what not to do. And we've created something really special here in California.
Okay. And that's in many ways, your performance has been quite extraordinary. I know when people ask me about you guys and since inception, about 15% return, and that's in respect to what you've had listed here in Australia. But
Right.
if you look at your success, what's different about the way you pick companies and ultimately your portfolios, which perform brilliantly?
Well, there are two big ideas that where we really believe, we know that we have a great ability to exploit inefficiencies in the market. And the first one is around how we look at competitive advantages. Peter, you've been in this business a long time. You've heard people come on your show and talk to you about investing and tell you three things. Peter, this is what we do philosophically. We buy high quality businesses with strong competitive advantages, selling at a discount to intrinsic value or cheaply.
Mm.
And it's like, I mean, come on. If that's all you're doing, the probabilities of you outperforming is probably zero because that's what everybody does. Who does? No, who's ever going to tell you that they go out and buy really lousy companies with no competitive advantage and they want to pay a high price? So we learned a long time ago that you've got to think about competitive advantages differently. Typically, and Buffett popularized this notion of buying really wide moat businesses. He thinks about a business as a castle with a moat around it. And the bigger the moat, the more protection from competitors, and the less likely that competitors are going to be able to get to the castle and take away their profitability. Well, that doesn't work as well anymore because there are a lot of great businesses in the past that have had huge moats, but ultimately those moats or those competitive advantages have been disrupted. It's happening much more rapidly today than it's ever happened before. So our whole notion around competitive advantages is not to look for businesses with very, very big ones, but to try to own businesses where the probabilities are really high over the next decade or two that the competitive advantage is likely to get stronger. And that's a complete reframing of the question. It's not just good enough to have a big competitive advantage. You want to own a business where you can make the case that the competitive advantage is going to grow over the next decade or two. That's one really important difference from everybody else in the industry. And the second one is the emphasis on people. Um, Look, every organization is about people. They people like to make these stereotypes about these inanimate objects called corporations. But the reality is people make up those organizations. And what we look for is we want to find the set of values in the organization, what those values happen to be. We look for alignment between the values and what they're trying to do on the strategy side. That's really important. So in a retailer, for instance, a great retailer, every great retailer you and I have ever walked into has happy employees, right? Because it's so obvious. If you have happy employees, we're going to have great experience. We'll come back, shop more, and the shareholders would do better. But that may not be the right corporate values for an industrial company or a tech company or even a railroad company. They're going to have very different values. But the key point is every company has a set of values, and what you try to find, and we try to find, is an alignment between the values of the business and what they try to do on the strategy side. And then we look for strength across the board to see that those values are embedded in the business. And then more importantly is adaptability. Because as you know, Peter, you've seen it a lot over the last 30, 40 years. The world changes quickly. And if you don't have an adaptable culture that changes as the world changes, you're going to be irrelevant. And the best example of that is it's an old one, but it's a beautiful one, is Nokia. Back in 2007, every one of us either had a Nokia phone or a BlackBerry phone. Nokia had 53% share of the cell phone market. They were a dominant player. They had great returns on capital. They had lots of free cash flow, huge moat, huge competitive advantage, and it was really selling cheaply. In fact, on Wall Street, 23 of 23 analysts had a buy recommendation in 2007. And we all know what happened, right? Ultimately, that company got disrupted by the iOS and the Apple iPhone, and then more importantly, the Android operating system that allowed cheap Asian manufacturers to make phones. So, yeah, it had a great moat, but the reality is that moat was declining, and no matter how cheap the price of the stock got, it was not worth it. And it kept getting cheaper and cheaper until Microsoft bought what's left of Nokia for $5 billion. And then they got rid of one of the great brands in the world, Nokia. So it's all about the direction of the moat. It's all about the people and adaptability. And that's why I brought up Nokia. They were not adaptable. When the world went to the smartphone, they stuck with the old brick phone and they weren't willing to change. And because they weren't willing to change, they became irrelevant.
Yeah, exactly. I remember when you came on my TV show many years ago, I asked you what was the latest company you added to the portfolio, and I was quite shocked when you said Ferrari.
Uh-huh.
Yeah.
And it's still in there, and it's been one of the great investments. That's an interesting, everyone thinks of Ferrari as a car company,
Mm.
but we don't see Ferrari as a car company. It's a luxury brand. A real funny story. Uh, So Ferrari's a luxury brand. They only sell 10,000 units a year across the globe. Uh, the Camry, or the is, I think we in the U.S. we buy 500,000 Camrys a year. 500,000. Ferrari sells 10,000 across the globe. Now it is impossible to get a new Ferrari unless you have an older Ferrari. We actually have a client who owns a bunch of dealerships across the western coast of the U.S. And he walked into a Ferrari dealership, didn't own a Ferrari dealership, and he said, "I'd like to buy a Ferrari." And they said, "Well, you can't." "Well, what do you mean I can't?" "No, I'll pay whatever you want me to pay." "Well, you can't buy a Ferrari because you don't own a Ferrari." And he said, "Well, how do I buy a Ferrari if I don't own a Ferrari? How do I get a Ferrari?" "Well, you got to go buy a used one. And then if you're lucky, in 3 years, you can come to us and maybe we'll sell you a Ferrari. Maybe we won't." And the whole process is the scarcity of the product and the brilliant. And these cars sell for an average of $500,000 a piece. So being a car dealership owner, he said, "Look, I'm not even going to deal with this system." He went out and bought the Ferrari dealership in Arizona so he could get his own Ferrari. Now he had the money to do that, but the point is, it is a luxury brand with a lot of scarcity to it. It's not an automobile company, and if you reframe it around it being a luxury brand, then you can look at it and say, you know what, the valuation that looks high right now actually is probably worth it because of the scarcity premium people are willing to pay for that car. And we still own it today, by the way, Peter.
Yeah, I'm enough surprised. And Paul, I think a lot of people are, who've invested in WCMQ, are fascinated that the driving force of that is WCM, which effectively is a non-listed fund manager in the US, but you are listed here in Australia, and culture's a significant point of difference. When you select a company, culture is really important. Has that had a big impact on your company and the culture in your company? Or is this just something that you guys look for, but not necessarily have prevailing in your own company?
No, that's a great question. And the reality is, when I talked about the founder early on, about how difficult he was, that the gift he gave us was how important culture and people are to the success of an organization. He founded the firm in 1976, and when we bought it in 1998, they only had $200 million of assets under management. In that 22-year period of time, never could get above that. And the reason for that is he controlled all the equity, he made all the money, he made all the investment decisions, and he made all the business decisions. So what happens in an organization like that? Well, when you have talent, they're going to soon realize they can have no impact on anything in the company and they leave. So we had this revolving door of talent throughout the history of the organization, and he could not grow in a period of time when he should have been a multi-billion-dollar asset management. So when we bought the company and we sat down, we said, okay, we've got to fix this culture that's highly toxic. How do we do it? Well, what would the founder do? Let's go 180 degrees the other way. We'll probably build a really nice, healthy culture. So he owned all the stock. Let's build a company where, now 67 people own shares in the company. That's magical, because when people own shares, they behave and act very differently. They act like owners. Pay was very opaque. Let's make pay very sounds basic, but let's make it really transparent so people know exactly how they're going to be compensated, and there are real metrics there. And then in terms of, I tell this really funny story. Every day he would walk in the office and we had 12 people at the time, and he walked back to his office and he closed the door at 8:30 in the morning, and wouldn't come out until he left at 5:30. And the only way you could talk to him is he had a mail slot on his door. You'd have to write a little note and say, "Hey, Daryl, can I ask you a question?" Put it through the mail slot, and he may or may not answer it. You may just sit there for 15 minutes waiting for him to answer. Well, we went as far away from how we ran the company as we possibly could, and we empower people. We try to get people into the areas of genius. We care about people. It sounds so basic, but if people know you care for them, they'll give you everything they have. And as a result, we started to grow. And then a few years later, it dawned on us, my gosh, if this made such a difference to us, we ought to start doing this with the companies we invest in. So the interesting thing, Peter, is we now have 4 full-time business culture analysts who only look at the people side of the equation in every organization. We try to figure out what animates the business, what drives them every day to be great, And, so these 4 full-time business culture analysts spend all their time on the phone talking to former employees who left on good terms. That's a great way to figure out what's going on in a company, right? Don't get people that were let go, the people that left on their own terms, and ask them a series of questions. That we have about 15 questions we've worked on, where we then begin to build a mosaic of what it's like inside that company and how it operates. And then the beauty of that is you can keep updating your work after you own the business, and then you learn and you see how they behave in difficult periods of time. And so it's those behaviors that are really important to long-term success of any enterprise. And we keep, we do a ton of work in that area. Everyone talks culture, as you know, Peter. Nobody does the work on it that we do.
Yeah, it's funny, when you and I were young enough to be listening to the Beatles and the Rolling Stones, and maybe the Eagles as well
Oh yeah.
on the hit parade, as they call it in those days. I was in, London, I was reading the Times, and they had a competition between fund managers, and one of the people competing to see who could pick the best, portfolio over a given period of time was a pharmacist from Luton who actually won the competition. He actually outperformed all the fund managers, and when the journalist asked him how he performed so well, he said, "Well, every company I selected," he said, "one particular, I waited outside the gates of the factory and talked to the workers as they came out." And
Right.
he said, "Where they were happy, as you pointed out, where they loved working at the place," he said, "that was a place I wanted to invest in." That was the first time I ever saw how important culture was, and this, Indian pharmacist in Luton, he picked it before any fund manager did.
No, it's brilliant. The really interesting thing, Peter, about it is the financial markets, wherever they are in Australia and Europe and the US, financial markets and people that have been trained in to analyze businesses. This is the interesting part. They don't believe anything exists unless they can quantify it, unless they can put it in a spreadsheet, build a little formula, and score it. And that's the beauty of what we do. You cannot score people and culture. You are built. So if the financial markets don't believe it exists, we have a massive inefficiency to exploit. So it's really about building a mosaic, and you build that mosaic with a lot of hard work, and then experience is a huge plus to making decisions on culture and people.
So, Paul, how does your team pick a company that's got good culture, and have you rejected companies that were great performers, but their culture is getting worse and worse? I can think of a couple of Magnificent Seven companies that have had they've done well, but their culture has got worse over time.
Oh yeah, well, it's really interesting because you know how people everybody knows Jack Welch from GE.
Mm.
And he was like he was the guy. He wrote his books about his Six Sigma investment or his, management philosophy. Remember, he had this idea that he thought was brilliant that every year he'd call the bottom 10% of performance and performers in an organization, and then the financials got better and better, and the stock did really well during his tenure. Well, you know what? It had nothing to do. Actually, what he did is he crushed the morale of the people in the organization, because if every year, everybody knows that there are going to be 10% of the workforce is going to be gone, you're not going to get the best out of people. Now, he got lucky, in my opinion. He happened to get this like really old stale conglomerate and started carving it up and rationalizing. Okay, that worked for him. But the reality is his management and culture strategy doesn't work. One of his guys went to Home Depot. Do you have Home Depot? You have Home Depot, and do you have Home Depot in Australia?
No. We have a
Something like
Bunnings is our Home Depot.
yeah,
Okay.
okay.
Yeah.
Yeah, so this guy Nardelli, who was one of his proteges, went to run a very entrepreneurial, decentralized company in Home Depot, one of the great businesses in the U.S. And what he did is he took that Six Sigma philosophy and brought it to an entrepreneurial, decentralized culture. And so he brought, all the purchasing decisions into Atlanta, the headquarters, didn't give it to the managers. He decided that, oh my gosh, we have so many people that are making so much money. Let's get rid of that talent and bring in part-time employees and pay them a lot less. And then he also brilliantly said, I'm going to put an HR person in every store. And they probably had 600 stores at the time. And it wasn't to help people. It was so he had eyes on the ground so he could watch people. And he absolutely decimated the culture of that company, and the financial performance, followed that decimation of people. You see it all the time. We owned a company for a lot of years called Shopify, which is, kind of it's a platform that allows people to put their business online. Very well known Canadian company, and had done really well up until about 2000, right through COVID. And then the founder decided, the CEO and founder decided that, hey, we no longer need offices, during COVID. Let's get rid of all of our, and they had something like 3 or 4 thousand employees. We're going to all work remotely. And when he made that decision, we sold the company, because there is no way that you can build a cohesive, healthy culture working in your mom's bedroom in your bathrobe. You can't do it. It doesn't work. So we sold the company because we saw massive deterioration coming in the form of the culture and the people. You've got to have water cooler talk. You've got to be able to pass people in the, your best conversations are sidebar conversations, just walking by somebody in your office.
So if an investor wants to use your investing style, apart from investing in WCMQ, just for the sake, because you are a sharing, caring kind of guy, Paul. How does someone identify a company with good culture?
It's a lot. It is a lot of work, and you have to. There's a bunch of different. We use expert networks, which are very expensive consulting firms that have thousands and thousands of people on their roster that we can talk to. So let's just say we want to learn something about Sea Limited, which is an e-commerce fintech company, out of Singapore. And we really want to know about how Forrest, who's the founder of that company, operates, and what behaviors does he honor. So we will call up these various expert networks and say, can you get us a meeting with various people within the organization now, and also various people who have left on their own terms. And then as we the beauty of it is we worked with a gentleman named James Heskett, who was a former Harvard business professor. He wrote a great book called The Culture Cycle, and he's the one who helped us identify that you want cultures that are aligned and strong, where the behaviors are strongly believed throughout the organization and adaptable. He helped us come up with a series of questions that we asked everybody in an organization. And by the way, everyone thinks, we can talk to any CEO in the world, because, we're big enough, we own enough, we're probably on the top 10 shareholders of most of the companies we own. They're easy to access for us. But those aren't the people you want to talk to, right? Because you're going to get a scripted response. They're going to tell you the story they want you to believe. Your best responses come from the line workers and like you said, standing outside the factory when the factory closes down and asking a series of questions. That's a brilliant way. So vendors, people that sell to them, competitors. We love to ask one company, which competitor do they fear most and why? So again, this is work that takes months and months of time to do from 4 people, but you do start to create an incredible mosaic of what behaviors are honored in the organization. It's hard to do on your own.
Yeah. So let's talk about another company that's been fairly important to you this year, AppLovin, which that Australians have never heard of before. And it's clearly done very well. What's the competitive growing moat that a company like that, say, 'cause it was up about 600% at one time, and I think a hedge fund manager made probably false accusations, and the share price fell a bit, but it's still up a massive amount. What's the growing competitive moat that you see there?
Yeah. Well, it's a very, very fascinating company. As you said, it was up 700% last year, and it still continues to be the single largest holding in our portfolio, which you might say, oh my gosh, it's got to be incredibly expensive. We think it's in the early innings still. So what AppLovin does is they actually created the advertising for mobile games. So, if you ever play a mobile game and on your phone or your iPad, and an ad pops up, that has been created most likely by AppLovin. That's what they're known for. And sometimes they're annoying, but they work. So they have figured out an algorithm where they say, okay, the average age of somebody playing this particular game is 35. So this is the right ad to associate with that game. You and I, Peter, they're going to sell us geriatric, ads all day long because, we're going to play games that the older people play. They've
Luxury cruises, Paul. Luxury cruises.
luxury cruises. I like that better. But they literally have built an algorithm using AI that it's a kind of a black box, but it works brilliantly for tying advertisers to the players of the game. It's been very efficient, but this is why it's so exciting. The reason we're so excited about it is they are now moving into e-commerce. So they're going to take that model that's worked really well from mobile gaming, and they're going to now go into e-commerce and with this same algorithm that's just crushing the competition. And so the market for them has gone from maybe this big to this big. So we still believe, and by the way, it's about $100 billion company market cap. I believe they have 1,500 employees. That's it. So it's incredibly efficient. Adam, the founder of the organization, is constantly culling the world for the best talent he can possibly buy, and they have been brilliant at taking market share across the board, and they will continue to take it as they move into e-commerce.
Do you think there's something I haven't covered effectively that people should know about your great performing that fund?
Well, here's an interesting point that is a good question. Back in 2021, everybody remembers that was really the market did 2020, 2021, the markets did great. And growth stocks, the kind of companies that we buy, did exceptionally well. And at the end of 2021, everybody owning growth stocks pretty much had the same great performance. And then, of course, 2022 hit, right? Every asset class of quality, whether it was growth or value, even high quality bonds around the world got decimated. I think high quality bonds were down something like 15%, which is unheard of, right? Because we had rising rates and rising inflation and rising rates. So in 2022, we didn't just sit there and say, this is what we always do, let's just keep doing it. What we actually said to ourselves, we sat down and had a meeting with the whole research team, which is about 25 people. And we all agreed that we've had a great tailwind in growth. Growth has done well. And what we need to do is this is the time when we have to separate ourselves from the pack. We need to separate ourselves from all the other growth managers out there over the next 2.5 and 3 years. So the way to do that is, in our mind, was to really think more of where are companies inflecting upwards from here. Now, this is like at the trough of 2022. Where are companies starting to inflect? It may not just be in technology. It may not be in only healthcare or consumer names, which are the names that most growth managers own. And when we started doing that work, looking for companies that were inflecting upwards, about 3 years ago, we found that, aerospace is an interesting space. Most growth managers don't buy aerospace. We have an aging fleet of airplanes across the globe, and they're going to have to be replaced. And companies that supply parts for those airplanes are probably going to do pretty well. So we made some investments in aerospace that have just performed beautifully. Defense. Now, this is really interesting. European defense in particular. We started looking at the European defense companies, and we started to see these inflections upwards in their financial performance. And of course, now, with Europe having to arm itself and actually invest more in defense companies, we were very, very early to that general idea. We continue to own those names. We think that, and they've done, we've got a couple of companies that are up 200 or 300% in 2.5 years in the defense area. Even things like gas turbines, which, oh my gosh, growth managers don't buy gas turbines, but why would you buy that? Well, data centers. I mean, I'm sure Australia is building data centers everywhere they can find space for them. They use a massive amount of energy.
Paul Black, you're not only a great fund manager, you're actually a great American. And I don't say that to many Americans. You know that.
Well, I have an American flag behind me, and you can see I turned it around so it wouldn't annoy your people.
No. Despite some recent developments, you still are one of our greatest allies. We know that. Paul, thanks for joining us, mate. Thanks for joining us.
Thank you. Great to see you, Peter. Take care.
Thanks for joining us today. And remember, if you have any questions on anything you've heard here today, or any questions relating to WCMQ's secondary issue, call or email Associate Global Partners.